Welcome to Smart Property USA, the podcast where we dive deep into the realities shaping America's economy, one data point at a time. I'm Alex, your host and housing market analyst, and today, September 11th, 2025, we're tackling what many are calling the defining crisis of our generation, the U.S. housing affordability meltdown. Picture this. You're driving through a quiet suburban street at dusk, only to spot rows of vans and RVs parked indefinitely, not for adventure, but as makeshift homes. This isn't a dystopian movie. It's the stark reality for tens of thousands of Americans right now. The latest data show a staggering 771,480 people experienced homelessness on a single night in January 2024, marking an 18% jump from the previous year and a 30% surge since 2022. That's about 23 out of every 10,000 people in the U.S., with chronic homelessness hitting 152,590 cases, nearly double the 2016 low. But this crisis isn't just about those on the streets. It's squeezing everyone. Home prices have soared 60% since 2019, with the median existing single-family home hitting a new high of $412,500 in 2024. Early 2025 data show a 3.9% year-over-year increase, keeping the pressure on. To afford that median home with a 30-year mortgage, 3.5% down payment, and a 31% debt-to-income ratio, you'd need at least $126,700 in annual income, up from $79,300 just 4 years ago. Yet, with median household earnings hovering around $75,000, only a fraction of families qualify. Renters are hit even harder. A record 22.6 million households, 50% of all renters, were cost-burdened in 2023, spending over 30% of their income on housing, including 12.1 million severely burdened at over 50%. For low-income renters earning under $30,000, that's 83% facing burdens, leaving just $250 monthly for everything else after rent. The national housing wage stands at $33.63 per hour for a modest two-bedroom rental and $28.17 for a one-bedroom, far beyond what many can earn. This isn't a temporary blip. It's a systemic failure fueled by a housing shortage estimated at 7.1 million units affordable and available to extremely low-income renters. Only 35 units for every 100 such households. Nearly 57% of U.S. households, 76.4 million, can't afford a median-priced home in 2025. First-time buyers, they've dwindled to historic lows, with homeownership rates slipping to 65% in Q2 2025, the lowest since 2019. Gen Z and millennials are delaying dreams by a decade due to student debt and rising costs, while corporate investors gobble up inventory, turning neighborhoods into rental empires. So what does this mean for you? Whether you're a renter eyeing your first home, an investor scouting opportunities, or just worried about the American dream fading, stay tuned. In this episode, we'll uncover 3 hidden factors worsening the crisis. Hint: one involves Wall Street's secret play, spotlight 5 markets where smart money is flowing, and reveal affordable alternatives like container homes under $500 a month. Backed by fresh data from top sources, we'll equip you with actionable insights. Let's turn the tide. Hit subscribe, and let's dive in. Let's start with a number that should shock the conscience. According to the latest data from the U.S. Department of Housing and Urban Development, homelessness in America surged by a staggering 18% in just 1 year. That's not just a statistic. That's over 771,000 of our fellow Americans without a roof over their heads in 2024. And all the indicators point to this devastating trend not just continuing, but accelerating into 2025. To put a face on that number, look no further than Los Angeles. Every single night, over 23,000 people in the city are forced to call a car, a van, or an RV their home. But here's the critical nuance that often gets missed. This is no longer just a crisis of poverty. The American middle class is now on the ropes, fighting a losing battle for basic housing stability. So, what's pushing them to the brink? Let's look at the numbers. Zillow Research reports that as of July 2025, the median home price in the U.S. sits at $368,581. That's a slight increase of 0.3% over last year. But while home prices have plateaued at a breathtaking height, rental prices have shot into the stratosphere. The average rent has now hit $2,072 per month, a punishing 2.6% year-over-year increase. What does this mean for the dream of homeownership? According to a groundbreaking analysis from Harvard's Joint Center for Housing Studies, to afford that median-priced home of $368,000, a household now needs an annual income of at least $126,700. And that's assuming you've managed to save a 20% down payment and can secure today's mortgage rates. Now, let's hold that number, $126,700, up against reality. The median household income in the United States is approximately $75,000. This math doesn't just create a gap, it creates a chasm. The National Association of Home Builders calculates that nearly 57% of American families cannot afford a $300,000 home today, let alone one pushing $370,000. The data from the Federal Housing Finance Agency paints a clear and frustrating picture. Home prices are still climbing, up 2.9% year-over-year as of Q2 2025. But sales volume? It's frozen solid. Why? A crippling lack of inventory. This has pushed first-time buyers, the lifeblood of a healthy housing market, out of the game entirely. They now account for only 24 to 30% of purchases, the lowest share since 1981. The direct result? The U.S. homeownership rate has fallen to 65% in the second quarter of 2025. That's the lowest it's been since 2019. And for Generation Z, the picture is even bleaker. Only 26% of Gen Z own a home. For millions, the dream is being delayed by a decade or more, shackled by the anchor of the average student loan debt, which sits around $30,000. So let's be perfectly clear. This is not a crisis of supply, at least not in the traditional sense. We have houses. What we have is a catastrophic crisis of affordability. The fundamental link between hard work, a good income, and a place to call your own is breaking. And with every passing month, this affordability crisis isn't just reshaping the market. It's threatening to shatter the very foundation of the American dream. So we understand the scale of the crisis. But what's really happening beneath the surface? Why does this problem feel so intractable? Today, we're pulling back the curtain on the three hidden factors driving this affordability nightmare. Factors that Wall Street and big institutional money would rather you not focus on. This isn't just market forces, it's a perfect storm. Let's start with Factor 1, the policy paradox. On one hand, you have Treasury Secretary Scott Bessent publicly declaring a national housing emergency this fall to address the estimated shortage of 4 to 7 million homes. The rhetoric is there. But on the other hand, the latest federal budget slashes $26.7 billion in housing assistance programs. That cut directly impacts an estimated 2 million households, pushing them closer to the brink of instability or outright homelessness. Now, contrast that with this. To soften the blow, the Federal Housing Finance Agency, FHFA, has doubled its investment in the Low-Income Housing Tax Credit, or LIHTC, program to $4 billion a year to build affordable units. It sounds good, right? But here's the paradox. That $4 billion, while crucial, doesn't come close to filling the $26.7 billion void. The net result? Less support for struggling renters, which pushes rental demand and prices even higher. It's a classic case of one arm of government trying to build a ladder while the other is chopping down the tree. Which brings us to Factor 2, and perhaps the most frustrating one for economists, the golden handcuff effect or the lock-in phenomenon. Data from FHFA shows that a staggering 76% of all outstanding mortgages have an interest rate below 6%. But if you walk into a bank today seeking a new mortgage, you're facing an average rate of 6.56% or higher. Think about that. If you're a homeowner with a 3% mortgage, the idea of selling your house to buy a new one is financial suicide. You'd be trading your low payment for one that's potentially double. This massive lock-in effect has frozen the market. Harvard researchers estimate it's preventing between 1.33 and 1.72 million transactions that would have normally happened. So, while demand is sky-high, the supply of existing homes for sale is stuck in deep freeze. Basic economics tells us that low supply plus high demand equals relentlessly high prices. In cities like Los Angeles, only 1.1% of homes are affordable to the median income earner. In San Jose, the median home price is 12 times the median income. Even in previously affordable markets like Durham, North Carolina, affordability has plummeted by 8.6%. Now, for Factor 3, the real game changer and the true shocker, the corporate invader. This isn't your neighbor buying a second property. This is Wall Street. In the first quarter of 2025, institutional investors bought up between 27% and 30% of all single-family homes sold. Their targets? High-growth Sun Belt markets like Atlanta, Charlotte, Dallas, Houston, Phoenix, and Tampa. In some of these areas, they now control a staggering 36.8% of all single-family rentals. Let that sink in. This year alone, Blackstone dropped $3.5 billion to acquire Tricon Residential, adding another 38,000 properties to its empire. Even Warren Buffett's Berkshire Hathaway is investing heavily, pouring over $1 billion into major home builders. The implication for you, the everyday American? You are no longer just competing with your fellow first-time buyers. You are bidding against billion-dollar funds with bottomless pockets, all-cash offers, and algorithms that can outmaneuver any human. They aren't buying a home, they're buying an asset class. This aggressive investment pushes purchase prices into unattainable territory for families and then transforms those same homes into permanent rentals, turning the dream of ownership into a perpetual and expensive rental trap. These three forces, contradictory policy, the locked-in market, and corporate acquisition, are the hidden engines of this crisis. And understanding them is the first step to finding a way out. So, in the face of these overwhelming forces, where is the so-called smart money going? It's not doubling down on the same broken model. It's pivoting, finding creative solutions and undervalued markets. Based on the latest data from Zillow and FHFA, here's where the savvy players are looking. First, they're looking beyond the coastal chaos to secondary cities and the Midwest. Take Grand Rapids, Michigan, for example. Millennial homeownership there is a whopping 60%, compared to just 22% in Los Angeles. Why? Because the income needed to buy a home is around $75,000, an actual, attainable number for many families. Markets like these across the heartland are seeing stable, sustainable price growth of around 1.5%, not the wild volatility of the Sun Belt. Second, there's a massive surge in manufactured housing. Forget the old stereotypes. This is one of the fastest growing segments, with production up 15.9% in 2024. The average cost for a new manufactured home is just $119,400, leading to a monthly payment between $563 and $850. That's not just affordable, it's a game changer. Third, tiny home communities are exploding from a niche trend into a serious market sector, now valued at over $21.9 billion. They represent a fundamental shift in prioritizing financial freedom over square footage. And fourth, the most surprising area of growth, ADUs, accessory dwelling units. Policy is rapidly changing to encourage them. California now allows up to 8 ADUs on a single multifamily lot. Massachusetts has pre-approved 900-square-foot designs. Colorado is mandating that cities allow them by June 30th, 2025. The data is clear. A surge in ADU construction increases local housing supply by up to 20% and can help reduce area rental prices by 10 to 15%. So, what are the practical alternative solutions for you? Let's talk specifics. Companies like Boxable are pioneering factory-built container homes that ship flat-packed. Prices range from $54,500 to $99,500 for a 361-square-foot unit, with monthly payments potentially as low as $250 to $500, often with ownership in as little as 5 years. Another powerful strategy? Buying raw land. You can find parcels in states like Arizona and Texas for between $5,000 and $30,000. With a land loan, your payment could be just $200 to $400 a month. Then, you can place an affordable manufactured home on it, potentially creating your own homestead for a total cost under $100,000. The key is to research zoning laws in land-friendly counties like Cochise, Arizona, or Costilla, CO. The math is undeniable. This path is dramatically cheaper than the national average rent of $2,100, and, most importantly, it allows you to build real equity. We don't have to look far for inspiration. In Singapore, over 90% of residents own their homes, largely through proactive government housing programs. Canada has committed $40 billion to build 101,000 new homes. So here's your playbook. First, investigate the over 2,000 down payment assistance and grant programs available nationwide. Some, like in New York, can offer up to $100,000. Second, seriously research the ADU rules in your area. Third, shed the stigma and explore manufactured housing. The traditional market, according to J.P. Morgan analysts, will remain largely frozen, with prices growing less than 3%. It's hampered by a shortage of 439,000 construction workers and tariffs that add an average of $10,900 to the cost of a new stick-built home. In this new reality, the winners will be those who think differently. Cash buyers moving into these alternative options, investors in the manufactured home sector, and individuals securing land in the Southwest. The American dream isn't dead. Its address is just changing. So let's be clear. The core of this crisis isn't a simple lack of houses. It's a profound crisis of affordability, a problem a decade in the making. A recent poll shows that a staggering 49% of Americans believe buying a home in 2025 is simply unrealistic. That statistic is a gut punch to the traditional American dream. But here's the most important takeaway. You are not powerless. This isn't about waiting for the market to crash or for a miracle. It's about adopting a new strategy. The dream of ownership and security is still within reach, but it requires a new blueprint. Your path forward starts with a single action. Choose one strategy we discussed and explore it today. Whether it's a boxable unit, securing a plot of raw land, or investigating building an ADU in your backyard, these are tangible, affordable steps toward building real equity and claiming your space. The American dream isn't dying, it's evolving. It just needs a new design. Thank you for joining us on this deep dive into the American housing crisis on the real market. We want to hear from you. What's your biggest hurdle? Share your thoughts in the comments. And make sure to subscribe so you don't miss our next episode on smart investing in this new landscape. Until then, this is Alex, signing off. Here's to you finding the keys to your future home, whatever form it may take.